Are you tired of living paycheck to paycheck and feeling like you're never going to achieve your financial goals? Do you want to learn how to budget, save, and invest, but don't know where to start? If so, this video is for you. Whether you're just starting your financial journey or looking to brush up on the basics, this video will provide you with the tools and knowledge you need to build a secure financial future. We divided the video into 7 chapters so you can easily watch the most relevant chapters. But I recommend you watch the video completely to get the most out of it. So grab a pen and paper and get ready to learn how to take control of your money and achieve your financial dreams. Chapter 1. Understanding your financial goals. It is important in managing your finances and making informed decisions about allocating your resources. It can help you create a plan for saving and investing, pay off debt, and achieve your long-term financial goals. There are many different types of financial goals, and they will depend on your circumstances and priorities. Some common financial goals might include building an emergency fund. This is a reserve of money to cover unexpected expenses, such as a job loss or medical emergency. An emergency fund can provide financial security and peace of mind. Another financial goal is to pay off debt. If you have high-interest credit card debt or other types of loans, paying them off as soon as possible can save you money in the long run and help to improve your credit score. Saving for retirement is another financial goal. Building a comfortable retirement fund can take many years of planning and saving. It's important to start saving as early as possible and to regularly review and adjust your retirement savings plan as your circumstances and financial goals change. The final goal is to buy a home. Owning a home is a dream for many people, but it's important to consider the costs and responsibilities of homeownership before making this commitment. Finally, it's important to set clear, specific, and achievable objectives to achieve your financial goals. It would help if you also considered the time frame for achieving your goals and how much you need to save or invest each month to reach them. Developing a budget and sticking to it can help you allocate your resources effectively and make progress toward your financial goals. Chapter 2. Budgeting and spending habits. Budgeting is creating a plan for how you will allocate your income and expenses over a specific period. To create a budget, you must track your income and expenses. It can be done manually with a pen and paper or using financial software or apps. Start by listing all your income sources such as your salary, wages, or investment returns. Then list your fixed expenses, such as rent or mortgage payments, insurance premiums, and debt payments. Finally, list your variable expenses, such as groceries, entertainment, and transportation costs. Once you have completed the list of your income and expenses, you can start to allocate your resources. It might involve cutting back on unnecessary expenses, looking for ways to save money on your fixed expenses, or finding ways to increase your income. It's important to be realistic and flexible when creating a budget because life is unpredictable and your budget may need to be adjusted as your circumstances change. So it's important to review your budget regularly to ensure you are on track to meet your financial goals. In addition to budgeting, it's also important to develop healthy spending habits. It might involve avoiding impulse purchases, shopping for the best prices, and avoiding overspending on credit. Budgeting and spending habits are essential for managing and achieving your financial goals. By creating a budget, you can take control of your finances and build a solid foundation for your financial future. Chapter 3. Developing a savings plan. Developing a savings plan is important in managing your finances and building financial security. It can help you save money for short-term goals, such as an emergency fund or a down payment on a home, and long-term goals, such as retirement. To create a savings plan, you must determine your financial goals and the amount of money you need to save to achieve them. It would help if you also considered the time frame for achieving your goals and how much you can realistically save each month. One effective way to save money is to set aside a portion of your monthly income in a savings account or other investment vehicle. It can be helpful to automate this process by setting up automatic transfers from your checking account to your savings account. This can make it easier to stick to your savings plan and avoid the temptation to spend your savings. In addition to saving money, it's also important to invest your savings in a way that is appropriate for your financial goals and risk tolerance. It might involve diversifying your investments across different asset classes, such as stocks, bonds, and cash. It's a good idea to consult with a financial professional or research to determine the best investment strategy for you. By setting specific goals, budgeting, and adopting responsible spending and saving habits, you can take control of your finances and build a solid foundation for your financial future. Congratulations! You have completed half of the journey to reach your financial dreams. Another half will be more exciting. So keep watching and please hit the like button if you found the video useful. Chapter 4. Investing Basics. Investing is putting money into a financial product or asset to earn a return on your investment. Many different types of investments depend on your financial goals, risk tolerance, and time horizon. Here are some basics to consider when starting to invest. 1. Risk and return. Investing involves some level of risk, but the potential for higher returns typically increases with the level of risk. For example, stocks are considered riskier than bonds, so they have the potential for higher returns. 2. Asset allocation. Diversifying your investments across different asset classes, such as stocks, bonds, and cash, can help manage risk and improve returns. Your asset allocation should be based on your financial goals, risk tolerance, and time horizon. 3. Investment vehicles. There are many different investment vehicles, including mutual funds, exchange-traded funds, individual stocks, and bonds. Each has its own set of risks and potential returns, and it's important to understand the characteristics of different investment vehicles before making a decision. 4. Fees and expenses. Many investments come with fees and expenses, such as management fees for mutual funds or commission charges for individual stocks. It's important to consider the total cost of an investment, including fees and expenses, before making a decision. Overall, investing can be a powerful tool for building wealth and achieving financial goals. But it's important to understand the basics of investing and to carefully consider your financial objectives and risk tolerance before making any investment decisions. Chapter 5. Understanding credit and debt. First, let's discuss credit. It is a financial tool that allows individuals and businesses to borrow money to make purchases or investments. Financial institutions such as banks and credit card companies issue credit. There are two main types of credit. They are secured and unsecured. Secured credit is backed by collateral, such as a car or house, which the lender can seize if the borrower fails to repay the debt. Unsecured credit is not backed by collateral and is based on the borrower's creditworthiness, which measures their ability to repay the debt. Now let's understand the debt. It is the amount of money a person or business owes to a lender. It can be classified as either good debt or bad debt. Good debt is debt used to make investments that can generate income or increase in value, such as a mortgage on a rental property or a business loan. Bad debt is debt used to finance unnecessary or depreciating expenses, such as credit card debt for non-essential purchases. Credit scores measure a person's creditworthiness and are used by lenders to determine the risk of lending money to a borrower. Credit scores are based on a person's credit history, including their payment history, the amount of debt they have, and the length of their credit history. A high credit score can make it easier to obtain credit and may result in lower interest rates on loans. Overall, understanding credit and debt is an important part of managing your finances. By using credit responsibly and managing your debt effectively, you can improve your credit score and build a solid foundation for your financial future. Chapter 6. Managing insurance and other expenses. Managing insurance and other expenses is an important part of personal financial management. Insurance is a financial product that protects against potential losses, such as medical expenses, property damage, or liability. Many types of insurance include health, life, car, and homeowners insurance. When shopping for insurance, it's important to consider the type and amount of coverage you need based on your circumstances and financial goals. It's also good to compare rates from multiple insurers to find the most affordable coverage. In addition to insurance, there are many other expenses that you will need to manage as part of your finances. These include housing, transportation, utilities, food, and entertainment expenses. To manage these expenses effectively, it's important to create a budget and stick to it. It will help you allocate your resources effectively and avoid overspending. Managing insurance and other expenses is an important part of personal financial management. By budgeting and looking for ways to save money, you can better control your expenses and progress toward your financial goals. Again, congratulations, because very few people have that strong desire to reach their financial goals, and you're one of them as you are watching the video till now. Many people will drop in the middle and be unable to reach their goals. But you start taking action by typing, "I reached my financial goals" in the comments section if you really want to reach your financial goals. Chapter 7. Retirement and estate planning. Retirement planning involves preparing for your financial needs after you stop working and are no longer earning a regular income. Estate planning involves organizing your financial affairs in anticipation of your death or incapacitation. There are many factors to consider when planning for retirement, including your expected retirement age and how much money you will need to support your desired lifestyle. It's important to start saving for retirement as early as possible and to regularly review and adjust your retirement plan as per your circumstances and financial goals change. Some common retirement savings vehicles include 401 plans, individual retirement accounts, and pension plans. Estate planning involves more than just creating a will or trust. It also involves organizing your assets to maximize their value and minimize taxes. Overall, retirement and estate planning are important considerations for anyone considering their financial future. By planning and organizing your financial affairs, you can help protect your assets. In conclusion, personal financial management is an essential skill for everyone, and it's important to be proactive, stay informed about your financial situation, and seek professional advice when needed. By following these principles, you can progress toward your financial goals and achieve financial stability and success. Thank you for watching. If you enjoyed this video, please give it a thumbs up and don't forget to subscribe to our channel for more helpful content like this. Until next time, take care and keep working towards your goals.